Silver just hit 90 an ounce, and nobody saw it coming. Last year it was 30. The year before that, analysts were calling it dead money. Now they're scrambling to explain why this metal, forgotten in portfolios and buried in vaults, suddenly exploded by 120% in 2025 alone. Something changed, something fundamental. You need to understand what's happening here because this isn't speculation anymore. This is physics meeting economics in real time, and the forces behind it aren't going away. They're accelerating. Start with the deficit, not the kind politicians argue about. The physical kind, the kind where the world demands 1.2 billion ounces of silver every year, but mines only produce 1.03 billion. That's a 200 million ounce gap every single year. For 5 years straight now, do the math on that. 800 million ounces of silver have vanished from global supply over the last 5 years. That's not a rounding error. That's not market volatility. That's a structural crisis playing out in slow motion until suddenly it isn't slow anymore. Until it's January 2026. And silver briefly touches 93 an ounce, and people are loading bars onto airplanes to fly them across the Atlantic because the price difference between London and New York makes air freight economically viable. Let that sink in. Silver is heavy. Shipping it by air normally makes zero financial sense, but fear does strange things to markets. Here's where it gets interesting. Most people think higher prices solve shortages. Supply increases, demand decreases, equilibrium returns. Economics 101. Except silver doesn't work that way. 72% of silver comes out of the ground as a byproduct. Some miner in Peru is digging for zinc or copper or lead, and silver just happens to come along for the ride, which means even if silver doubles in price, that miner isn't going to produce more. His operation runs on zinc economics, not silver economics. The silver is almost incidental. Primary silver mines, the ones actually targeting silver specifically, they only account for 28% of global production, and those take 8 to 12 years to develop from discovery to first pour. You can't fix this quickly. You can't just turn on more supply because the price looks attractive. The mechanism is broken. Traditional market forces don't apply. Meanwhile, demand is doing something it's never done before. It's bifurcating. Half the world wants silver as money, as a hedge against currency debasement and government dysfunction. The other half needs it as an industrial commodity that's absolutely critical to the energy transition and technological infrastructure. Both sides are competing for the same finite supply, and neither side can back down. Let's talk about solar panels for a second. Back in 2014, solar manufacturing consumed about 11% of industrial silver demand. Last year, it was 29%. Each panel needs roughly 20 grams of silver for its conductive properties. There's no good substitute. Copper doesn't work. Aluminum doesn't work. It has to be silver. The efficiency loss with alternatives makes them economically unviable. And the world is installing solar panels at an exponential rate because every government on Earth has committed to some version of net zero emissions by 2050. The International Energy Agency projects that by 2030, solar and electric vehicles alone will consume half of all silver mined globally. Half. That leaves the other half to cover jewelry, coins, investment bars, electronics, medical applications, water purification, and about 10 other industrial uses. The math doesn't work. Something has to give. Now add this. The technology is moving in the wrong direction for silver conservation. Older PERC solar cells use silver on just the front side of the panel. Newer, more efficient designs like TOPCon and silicon heterojunction cells need silver on both sides. They use 1.5 to 2 times more silver per gigawatt of capacity. The industry is trying to reduce silver content per panel through thrifting technologies and alternative metallization, but the shift to higher efficiency designs is offsetting those gains. Net result? Solar is going to consume more silver, not less, even as it scales. Electric vehicles are the same story. A regular car with an internal combustion engine uses maybe 15 to 28 grams of silver. A hybrid uses 18 to 34 grams. A full battery electric vehicle uses 25 to 50 grams. Every sensor, every power module, every charging system, it all needs silver for reliable electrical contact under high current loads. As the world transitions away from gas engines, silver demand from automotive alone is set to surge. Then there's artificial intelligence, data centers, server farms, the digital infrastructure powering ChatGPT and Claude, and every AI application proliferating across the economy. Each one of those facilities is packed with servers, switches, and electrical systems that require silver for thermal management and signal integrity. The AI boom isn't slowing down, it's accelerating. And every new data center built adds to industrial silver demand. You're starting to see the problem. Demand is structural and growing, supply is constrained and can't respond quickly, and we haven't even talked about what governments are doing. On January 1st, 2026, China implemented export controls on refined silver. Only large state-approved companies with annual production capacity of at least 80 tons can export now, and they need special government licenses. Hundreds of smaller exporters just got cut off. China controls 60 to 70% of the world's refined silver supply. This isn't a minor policy tweak. This is resource nationalism weaponized. China did the same playbook with rare earth elements, and it worked. They secured domestic supply, gained pricing power, and limited competitors' access to critical materials. Now they're doing it with silver. The impact was immediate. Lease rates for silver spiked above 8% within days. That's insane. Historically, silver lease rates hover near zero, sometimes even negative. When you're lending out metal, you expect maybe 1%, maybe 2% annual return. 8% on a 1-month basis means the market is screaming for physical silver and there isn't enough to go around. People who own metal are demanding massive premiums just to lend it out temporarily because they know they might not get it back, or if they do, the replacement cost could be astronomical. This is the same pattern we saw in 1980 when the Hunt brothers tried cornering the market and silver hit $7.50 an ounce. The last time silver went into backwardation like this was 1980. We're witnessing the same market structure today. What does backwardation mean? It's when near-term futures contracts trade at higher prices than long-dated contracts. Normally, it's the opposite. You pay more for silver delivered in 6 months than silver delivered tomorrow because of storage costs and the time value of money. But when backwardation hits, it means people will pay a premium for metal now, not later. That signals one thing. Physical shortage. And the shortage is real. COMEX registered inventories, the silver available for immediate delivery, are down nearly 70% since 2020. At the start of this year, traders were literally air freighting silver bars from London to New York. Silver is heavy. Shipping it by air across the ocean isn't profitable under normal circumstances. But they were doing it anyway because the fear of tariffs and supply disruptions made it worth the cost. When the economics of air freighting silver makes sense, you know the system is breaking. Meanwhile, inventories in London and Zurich are being drained. The vaults that back the global silver market are running low on good delivery bars. These aren't retail coins. These are 1 0-ounce bars that trade between institutions, refiners, and central banks. When those start disappearing, it's not retail investors causing the problem. It's industrial buyers, governments, and large financial players scrambling to secure physical metal before it's gone. What happens when inventories hit zero? Nobody knows for sure because it's never happened in the modern era. But you can imagine premiums explode, delivery delays stretch from days to weeks to months. Prices disconnect entirely from paper markets. Futures contracts get settled in cash instead of metal because there's nothing to deliver. It's not a hypothetical anymore. We're watching it happen in slow motion. Mexico isn't helping. The world's largest silver producer cut output by roughly 5% in affected regions after regulatory changes in 2024 and 2025. Fresnillo's San Julian mine, one of the biggest silver operations on the planet, partially ceased operations. Mexico isn't going to bail out global supply. Ore grades are declining. Permitting is a nightmare. Even if prices double, you can't just flip a switch and produce more silver when your mine is already running at capacity or shut down by regulators. Russia's in the same boat. Sanctions and capital constraints mean Russian miners can't expand operations even if they wanted to. Russian silver isn't flowing freely into Western markets anymore. That's another chunk of supply effectively offline. You're starting to see the picture. Supply is falling, demand is rising, inventories are vanishing. And the biggest refiner in the world just cut off exports. This is why silver went from 24 an ounce at the start of 2025 to over 89 by mid-January 2026, a 120% surge in 1 year, the strongest annual performance since the late 1970s. Gold did well too, up 65% in 2025, but silver crushed it. And that brings us to something most people don't talk about. The gold to silver ratio. For decades, this ratio hovered between 60 to 1 and 100 to 1, meaning you needed 60 to 100 ounces of silver to buy 1 ounce of gold. At the start of 2025, the ratio was above 100. Gold was massively overvalued relative to silver, or silver was massively undervalued relative to gold, depending on how you looked at it. By the end of 2025, that ratio had collapsed below 60. As of early 2026, it's hovering near 50. Silver is outperforming gold on a percentage basis, and the ratio is compressing fast. Historically, the long-term average sits closer to 15 to 1 or 20 to 1. If gold stays at 4,600 an ounce and the ratio reverts to 20 to 1, that puts silver at 230 per ounce. If it hits 15 to 1, silver would be over 300. Those aren't predictions. They're mathematical outcomes if historical norms reassert themselves. Will they? Maybe, maybe not. But the ratio compression we've seen so far suggests silver has significant room to run relative to gold. Why the compression now? Because silver isn't behaving like a monetary metal anymore. It's behaving like a critical industrial commodity in structural shortage. Gold is still primarily a monetary asset. Central banks hold it. Investors buy it as a hedge. Industrial use is minimal. Silver is the opposite. Nearly half of all silver consumed every year goes into industrial applications. Solar panels, electric vehicles, electronics, AI infrastructure. These aren't discretionary purchases. They're essential inputs for the global economy. When you can't substitute silver with something cheaper and production can't increase fast enough, prices have to rise until demand is rationed. That's what's happening. And then there's government behavior. The United States officially designated silver as a critical mineral for the first time in 2025. That's a big deal. Critical mineral designation means silver is now viewed as essential for national security and economic competitiveness. It makes silver eligible for strategic stockpiling programs. It justifies subsidies for domestic production. It signals that government demand could spike. Russia confirmed its central bank is buying precious metals, including silver, for reserves. China's export restrictions are effectively a stockpiling program by another name. Keep the silver at home for domestic use. Multiple governments are moving in the same direction. Secure supply, build reserves, don't rely on global markets. When governments start competing with industry and investors for a commodity that's already in deficit, prices go vertical. And this isn't theoretical concern. This is happening right now. Look at the physical market. COMEX registered inventories in the United States are down nearly 70% since 2020. That's not a minor drawdown. That's a collapse. Registered inventory is the metal available for immediate delivery, the stuff that backs futures contracts, the metal people can actually take home. When that drops by 70%, you're looking at a market that's running on fumes. London and Zurich vaults are experiencing the same thing. Metal is draining out at a historic pace. And here's where it gets strange. At the beginning of 2026, people were literally air freighting silver bars from London to New York. You don't do that under normal circumstances. Silver is heavy. Shipping it by air across an ocean costs a fortune. It's not profitable unless the market is in absolute chaos. But tariff fears and physical shortages made it worth the cost. That tells you everything about how desperate the situation has become. Normal supply chains are breaking down. Traditional shipping routes aren't fast enough. The market needs metal now, and it'll pay whatever it takes to get it. Lease rates tell the same story. Historically, silver lease rates hovered near zero or even went negative, meaning if you had physical silver sitting in a vault, you'd essentially pay someone to borrow it temporarily. There was so much available metal that lending it out had no value. That world is gone. In September 2025, lease rates spiked above 5% for the fifth time that year. By early 2026, they'd hit 8%. That's extraordinary. An 8% lease rate means holders of physical silver are demanding serious premiums to lend out their metal even for a month. Why? Because they're not confident they'll get it back. Or they know that if they lend it out, they won't be able to replace it. The metal simply isn't available. Then there's backwardation. That's when near-term futures contracts trade at higher prices than longer-dated contracts. Normally, futures curve upward because of storage costs and time value. You pay more for delivery 6 months from now than delivery today. Backwardation flips that. It means people will pay a premium to own physical silver right now instead of later. That's not normal. It signals either supply stress or urgent physical demand. Silver entered deep backwardation in late 2025 for the first time since 1980. Let that sink in. The last time silver was in backwardation like this, the Hunt brothers were trying to corner the market, and prices hit 50 an ounce. The fact that we're seeing similar conditions now without anyone deliberately trying to corner the market suggests the physical shortage is real and severe. So where's the metal going? Part of it is industrial consumption. Solar panels, electric vehicles, electronics. That silver is gone. It's embedded in products that won't be recycled for years, if ever. But there's another buyer stepping in that most people aren't paying attention to. Investors. Exchange-traded product holdings are up roughly 18% through November 2025. That's 187 million ounces of new investment demand in a single year. People are buying silver ETFs, coins, and bars because they see what's happening. They see the supply deficit. They see the price momentum, and they see the writing on the wall. When the Federal Reserve announced in October 2025 that it would stop shrinking its balance sheet, that was a signal. Quantitative tightening was over. The Fed was pivoting back to what it always does: print money, lower rates, inflate the debt away. Lower interest rates reduce the opportunity cost of holding silver. When you can get 5% on a treasury bill, holding silver that yields nothing feels expensive. When rates drop to 2%, that calculation changes. And if rates go lower, which analysts expect in 2026, the math shifts even further in favor of hard assets. But it's not just about rates. It's about trust. Fed Chair Jerome Powell became the subject of a criminal investigation in late 2025. Whether that goes anywhere or not, the fact that it's happening raises questions about Federal Reserve independence. If the central bank gets politicized, if it starts making decisions based on political pressure instead of economic data, confidence in the currency erodes, people look for alternatives. Gold and silver become those alternatives. And the money printing isn't subtle. US M2 money supply was 15.4 trillion in January 2020. 5 years later, it's 22 trillion. That's a 42% increase. You don't expand the money supply by 42% in 5 years without consequences. Inflation is one, currency debasement is another, the dollar buys less, savings lose purchasing power. And people start asking what holds value when paper currency doesn't. Silver, with its dual role as both industrial commodity and monetary metal, becomes an answer. It's useful in manufacturing, so there's always baseline demand, and it's historically been money, so it carries that monetary premium when trust in fiat currencies falters. This dynamic is playing out globally. It's not just the U.S. Western economies across the board engaged in massive fiscal expansion over the past 5 years. Government debt levels are at peacetime records. Central banks are trapped. They can't raise rates too high without blowing up debt service costs, but they can't keep rates too low without stoking inflation. It's a lose-lose scenario. And in that environment, hard assets outperform. Resource nationalism is the other piece of this puzzle. The US and China are both trying to secure control over critical materials. It's economic warfare by another name. China restricts silver exports. The US designates silver as a critical mineral and starts talking about strategic reserves. Both sides are signaling the same thing. Silver matters. It's not just a commodity you trade on markets, it's a strategic asset you control and hoard. If even a modest government stockpiling program kicks off, the math gets ugly fast. Annual silver mine production is roughly 25 tons. If governments decide to buy 10 to 20% of that for reserves, you're talking about 2,500 to 5, 0 tons of new demand hitting a market that's already short 160 to 200 million ounces per year. There's no slack in the system. There's no buffer inventory to absorb that. Prices would have to rise enough to destroy demand elsewhere. And what gets destroyed first? Investment demand? Maybe. Industrial demand? Not likely. You can't build a solar panel without silver. You can't outrun demand like this. Not when it's coming from every direction at once. Here's what the gold to silver ratio is telling you right now. For most of the past decade, you needed 80 to 100 ounces of silver to buy 1 ounce of gold. That ratio sat stubbornly high. Gold was king. Silver was the forgotten little brother collecting dust in the corner. But in 2025, something broke. The ratio collapsed from over 100 at the start of the year to under 60 by December. As of early 2026, it's hovering around 50. That's a massive compression in a short time, and it's bringing silver back to levels not seen since 2013. Why does this matter? Because historically, this ratio reverts to the mean, and the long-term average isn't 50. It's closer to 15 to 20. Go back to the early 1980s, and you'd find silver trading at ratios below 20. If that reversion happens again, if gold stays around 400-600 per ounce where it is now, silver would need to hit somewhere between 230 and 305 per ounce. Does that happen overnight? No. But the fact that the ratio is already compressing this hard suggests the market is repricing silver's true value relative to gold. Silver isn't just gold's cheap cousin anymore. It's a critical industrial commodity in a structural shortage, and the ratio is starting to reflect that reality. Gold is primarily a monetary asset. Central banks hoard it. Investors buy it as insurance. Industrial use is minimal. Silver, on the other hand, gets consumed. It goes into solar panels, electric vehicles, data centers, electronics. Half of all silver demand now comes from industrial applications. That silver doesn't come back. It's not sitting in a vault waiting to be resold. It's embedded in a product on a rooftop in California or inside a server farm in Virginia. This fundamental difference in how the metals are used supports a lower gold to silver ratio than what we've seen over the past decade. As industrial demand continues eating up supply, silver trades less like a pure monetary metal and more like copper or lithium. Commodities in shortage move differently than monetary assets. They spike harder and faster because you can't just print more of them when you need them. So where does price actually go from here? You're not going to get a clean answer. Forecasts are all over the map, but the range itself tells you something. Citigroup expects silver to hit the high 70s in 2026. Bank of America recently raised their 12-month target to 65. Metals Focus is calling for an average of 57 with a potential run at 60 later in the year. Those are the conservative calls. On the bullish end, Philippe Gisels from BNP Paribas told CNBC he wouldn't be surprised to see silver well north of 100 in the not-too-distant future. Veteran technical analyst Michael Oliver is suggesting a scenario where silver hits 100 to 200 by early 2026. Gold Silver's lead analyst Alan Hibbert expects silver to trade above 100 this year as supply deficits deepen and industrial demand accelerates. Silver doesn't need a miracle to hit 100. It needs the current conditions to stay in place. Easing rate expectations, a softer dollar, persistent physical tightness, enough geopolitical risk to keep safe haven demand alive. If those factors hold, 100 becomes probable, not just possible. And if momentum builds beyond that, some technical analysts are pointing to a multi-decade cup and handle formation, suggesting a measured target of 400 per ounce long term. That sounds absurd until you remember that silver hit 50 in 1,980 when annual production was around 300 million ounces. Today, production is 820 million ounces, but demand is 1.2 billion ounces. The fundamental imbalance now is worse than it was in 1,980, and we're starting from a higher production base with a larger deficit. But let's talk about what could go wrong, because nothing moves in a straight line and silver is volatile. If global growth slows significantly, industrial demand softens. Solar installations could plateau. EV production could stall. AI expansion could hit a wall. If risk appetite improves broadly and investors rotate back into equity, safe haven demand for silver drops. If central banks pivot back to tighter monetary policy unexpectedly, if inflation falls faster than expected and interest rates stay elevated, the opportunity cost of holding silver increases. And if China reverses its export restrictions, if geopolitical tensions ease and supply chains normalize, some of the physical tightness could unwind. Those are the bearish scenarios, and they'd probably push silver back into the 60 to 70 range rather than propelling it toward triple digits. The thing is, most of those scenarios require multiple trends reversing simultaneously. Industrial demand isn't slowing. Solar and EV adoption have policy momentum behind them that doesn't just evaporate. Central banks are more likely to cut rates further than hike them given government debt levels. And China's export restrictions aren't temporary, they're strategic. Resource nationalism doesn't go away once it starts, it escalates. What you're watching unfold is a repricing event. Silver spent decades being undervalued relative to its industrial importance. It traded like a secondary precious metal, something you bought after gold if you had money left over. That perception is breaking. The market is waking up to the fact that silver isn't optional in the energy transition. You can't build the green economy without it, and there isn't enough of it to go around. When a commodity becomes critical and scarce at the same time, price is the only mechanism left to ration supply. Somebody has to get priced out. Somebody has to use less. And until that happens, the price keeps climbing until demand destruction kicks in. The physical market is screaming this message right now. Inventory is depleted, lease rates elevated, backwardation in futures, silver being air freighted across oceans. These aren't subtle signals, they're alarm bells. And the longer the deficit persists, the louder those bells get. Here's what happens next. And it's not pretty for anyone still sitting on the sidelines. The deficit doesn't magically fix itself. Every year that demand outpaces supply, the hole gets deeper. 820 million ounces behind demand over 5 years. That's not a number that gets made up by finding a few new mines. It takes a decade to bring a new mine online. Permits, exploration, development. You don't just flip a switch. And remember, 72% of silver comes as a byproduct. Zinc mines, copper mines, lead operations. Those aren't ramping up production because silver hit Tyne 90. They're extracting what makes economic sense for their primary metal. Silver tags along. Higher prices don't change that equation the way they would for a primary silver mine. So where does the extra metal come from? Recycling can only do so much. Scrap recovery is already factored into supply estimates. You need industrial waste, old electronics, jewelry melted down. That's happening, but it's not adding hundreds of millions of ounces. It's incremental. The real answer is that somebody stops using silver. Demand destruction. Industries find substitutes. Solar manufacturers engineer panels that use less silver per watt. EV makers redesign battery systems. Electronics firms switch to copper or alternative conductors where possible. That's already happening at the margins, but here's the problem. Silver isn't just cheap and effective. It's the best electrical conductor on the planet. It doesn't corrode like copper. It performs in extreme temperatures. Finding true substitutes means accepting lower performance or higher costs elsewhere in the system. For high-efficiency solar cells, there's no real replacement yet. For critical electronics, the engineering trade-offs aren't worth it. So demand destruction through substitution, it's slow, incremental at best. The other way demand gets destroyed is through price. 90 silver makes certain applications uneconomical. Maybe some industrial uses get phased out. Maybe jewelry demand collapses because consumers won't pay the premium. Investment demand could theoretically drop if prices get high enough that people take profits and walk away. But here's the tension. Industrial demand is relatively price inelastic in the short term. You can't just stop building solar panels or EVs because silver got expensive. Those industries have policy mandates, government subsidies, and long-term contracts locked in. They'll pay what they have to pay. Investment demand actually increases when prices rise if the narrative remains bullish. People chase momentum, FOMO kicks in, and safe haven demand intensifies during crises regardless of price. So the mechanism that normally brings commodity markets back into balance, higher prices killing demand, it's not working efficiently here, which means prices have to go even higher to finally force enough users out of the market. Think about what that implies. If 90 silver hasn't triggered sufficient demand destruction yet, where does it need to go? 120, 150? Nobody knows exactly, but the market will find out through trial and error. Every spike higher tests the threshold. Some buyers drop out, some substitute, some hoard. The equilibrium price is wherever supply and demand finally meet, and right now that price is clearly above where we are. Then layer on the strategic dimension. Governments designating silver as critical, stockpiling programs potentially launching, export restrictions tightening. These aren't market-driven dynamics. These are political decisions that override normal economic logic. When nations compete for resources they deem essential to security, price becomes secondary to availability. You pay whatever it takes to secure supply. That puts a floor under prices that didn't exist before. Historically, silver could crash when speculative bubbles popped because there was always physical metal available somewhere. In 2011, when silver spiked to 48 and then collapsed, inventories were ample. The rally was driven by investment flows and speculation. When that reversed, metal flooded back into the market. This time is structurally different. The physical shortage is real. Governments are hoarding. Industrial users are desperate. There's no hidden stockpile waiting to be unleashed. The cupboard is genuinely bare. So if this rally stalls, if we get a correction, it's probably shallow and temporary unless the fundamental deficit gets resolved. And the deficit isn't resolving. It's getting worse. 2026 is projected to be the sixth consecutive year of structural shortage. The cumulative hold deepens. Every month that passes with demand exceeding supply by 15 to 20%, another chunk of remaining inventory disappears. At some point, probably soon, we hit a critical threshold where available metal for immediate delivery becomes so scarce that premiums explode regardless of futures prices. You already saw this dynamic starting in late 2025 with backwardation and spiking lease rates. Those are warning signs of a market approaching failure. Not failure in the sense of collapse, but failure in the sense that price discovery breaks down and physical premiums decouple entirely from paper prices. When that happens, the futures price becomes almost irrelevant. What matters is what you can actually get physical metal for, and that premium could be 20, 30, 40% above the quoted spot price. We've seen this in other commodities during extreme shortages. It's brutal for industrial users who need the metal to keep production lines running. They'll pay the premium because shutting down is worse. The strategy here isn't complicated. If you believe the deficit is real and persistent, if you believe industrial demand keeps growing, if you believe geopolitical resource competition is intensifying, then you're watching a repricing that has further to run. How much further? The market will tell you when it gets there. You'll know it's over when supply responses actually kick in, when substitution accelerates dramatically, when governments stop hoarding, when China reverses export controls. Until those things happen, the structural imbalance remains unresolved. And unresolved imbalances in critical commodities don't end quietly. They end with prices high enough to force change. That's where silver is headed. Not because of speculation or hype, but because physics and geology and geopolitics have created a situation where there simply isn't enough metal to satisfy everyone who wants it. The invisible hand of the market is about to become very visible, and it's going to be expensive. You've seen the forces now, the deficit that won't quit, the supply that can't respond, the demand that keeps accelerating from every direction, China locking down exports, government stockpiling, industries scrambling for metal that isn't there. This isn't a story about silver anymore. It's a story about what happens when the world runs out of something it absolutely needs, and the people in charge realize it too late to fix it. The alarm bells are ringing, backwardation, depleted inventories, lease rates at levels that shouldn't exist, metal being flown across oceans because the economics of desperation override the economics of sanity. These signals don't appear in healthy markets. They appear in markets that are breaking in real time, right in front of everyone, while most people still aren't paying attention. The price will find its level. Could be 100, could be 200, could be something nobody's willing to say out loud yet because it sounds too extreme. But the level it finds won't be determined by charts or sentiment or what analysts think is reasonable. It'll be determined by the point where enough users finally get priced out, where demand destruction actually happens at scale, where the pain of paying becomes greater than the pain of going without. We're not there yet, not even close. And until we are, the invisible hand keeps pushing higher every single day.